Welcome, everybody. Good morning, good afternoon, since it's noon here. Thank you for attending. Thank you for your interest in this subject. We're providing this investor training today for two reasons. The primary one is to reintroduce and provide a new reorientation to the handbook and how to complete due diligence processes faster. And the second is to try and begin introducing some new best practices around deal closure to help us be more effective, make better decisions, but also reduce risk as we make investments. And I will, given Keiretsu's growth, touch on a couple of things related to the handbook that can help younger chapters be more effective in using a handbook that we do know is sort of designed for chapters that have several hundred members. Before we continue, let me take a minute to thank Kim Castellanos and Breakaway Funding for both the use of their platform and also for Kim's assistance in fielding questions today. Breakaway Funding is a strategic partner of Keiretsu, and they're doing something innovative, I think highly beneficial to the private equity ecosystem. In addition to just raising capital for companies, Kim has taken her background in the banking industry and is working to help companies raise capital through crowdfunding and then position them in such a way that they become both viable and compelling debt investments for banks, and particularly community banks, to lend money to, which of course for investors is non-dilutive funding, and for banks gives them opportunities that they otherwise would not have. So thank you, Kim, for your time and your platform. For those that don't know me, let me mention a quick bit about myself, starting with the existential question of life, which is, how does one suddenly find himself as an authority on due diligence processes? Well, like many young boys, I had a dream of being a professional baseball player, only to find that my hand-eye coordination was not reliable enough to catch fly balls every time. So that led to a business career instead of a baseball career. And at some point, a few people were noticing several of my skills and attributes that that are really relevant to positioning companies. One of those is the ability to explain clear patterns in complex systems. Another is the knowledge and wisdom that comes from having been on both sides of the investor-entrepreneur fence. And another is the capacity to interact with the brightest of strategic minds and yet ground them, serve as a bridge to ground entrepreneurs in the operational reality of how companies need to be built. So with that background and without great hand-eye coordination, a few people recruited me to join a committee that was beginning to work in 2009 to revamp Keiretsu's due diligence processes. I ended up working with 20 very bright people, ended up chairing that committee and then co-authoring a prior version of the due diligence process handbook. And as Keiretsu began its international growth and the growth it's been in for the past few years, I ended up completely rewriting and expanding and revamping the handbook to meet our current needs. Speaking of Keiretsu's growth, for newer members, let me provide a quick orientation on what's been happening at Keiretsu. We're now, as of this recording, in March of 2016, up to over 2,500 members, funded over 700 companies. We're on 12 countries and growing on 3 continents. And that has made Keiretsu into a very interesting platform where companies can raise as much money from investors, private equity investors, and angel investors as can be raised from a venture fund. So what is happening with that platform? One of the chapter presidents of one of our largest regions used a term a couple of years ago, I think 2 years ago, that we don't just fund companies here, we take companies from cradle to greatness. And so in addition to funding companies and the initial vision for the Keiretsu Forum, which was great association with quality deal flow, we now do more than just fund companies. We include education and training resources primarily for investors, but also for entrepreneurs.
We have an informal association with earlier stage companies through seed pitch events. And the globalization has now created an environment in which we can syndicate among ourselves and invest as much in companies as a venture fund would invest. And in addition to those areas, we now have two new initiatives that are significant major initiatives. And the first is Keiretsu Capital. Keiretsu Capital enables best-of-breed applicants, best-of-breed portfolio companies to raise additional capital in addition to what's invested directly by members on an individual basis. And it enables members to diversify the same amount of capital across multiple investments and also multiple classes of investments. And secondarily, it allows indexing in private equity investments because the funds will invest and then invest subsequent amounts and follow-on rounds. Investments that Keiretsu Capital funds make, and I say funds because over time there will be additional specific funds investing in different industries, are made in companies that have been through the due diligence process and received significant traction among members. And that due diligence process always includes a review and assessment by members with industry knowledge, as we know, and then the investments are made after a vote of members who operate each fund. And that leads me to the second of the two major initiatives, which is Keiretsu Squared.
And so in addition to Keiretsu Forum, Keiretsu Global, Keiretsu Capital Funds, and the Keiretsu Academy, we now have Keiretsu Squared, which is here to protect investors by putting our own experts in to both actively de-risk companies and proactively design and implement their growth to produce the highest possible return for our members. And this goes beyond just bringing in our teams. Keiretsu Squared, starting with the Velocity program, is bringing our experts in a comprehensive, interdisciplinary, hands-on manner over a sustained 3-month period. So really, please go take a look at the Velocity program overview on the Keiretsu Squared section of the Keiretsu Forum website, and it speaks for itself. Stepping back for a minute before we get into the due diligence process itself, for those that are just new to being a member here, let's bear in mind that by the time companies enter due diligence, they've already gone through both a preliminary screening by people familiar with their industry and the deal screening, and then receive the drill down that comes from the mind share of members at the forums. So let's get into the due diligence process itself. The process is based on several values, and this is in Appendix A, and in every due diligence process, I encourage a team to go back and look at these values and remember that we need to be living up to these that are here for a reason. Open process, due care with public forum, respectful but thorough assessment, and the most important one on this list is really to make sure that contrarian views and deep critiques come with due process. And by that, we mean the committee that created these guidelines means that we vet all concerns, but we vet them based on facts and based on analyses, not based on blanket statements. So let me go into our objectives and outcomes for today, really 3 of them. First of all, my objective is to build a new mindset of how we can actually complete the same type of quality due diligence reports, but much faster. And part of that is re-looking at this handbook as a tool rather than an information resource. And then my commitment is to provide more value here than just talking about how to move the process faster. So we're going to start looking at introducing some new best practices in a negotiation and closing state that can create levels of communication and alignment that can de-risk companies. So we're going to go through what is due diligence. We're going to look back at the process as it's evolved and what we've learned from the process, how to move it faster, why that's important. Then we'll get into the handbook, and then we'll get into this new set of best practices about building alignment and influence for companies. Now, I keep joking about the dryness of the subject, but there is a mathematical formula as towards why it's important, where X is money put in and K is the power of investing as a cohesive unit. And so X plus K equals return, especially magnified. And if you don't do due diligence properly, X minus Y equals 0. So all humor aside, let's go on to the essence of due diligence. So due diligence is commonly thought of as going through a list and a checklist to verify, what I call verification level due diligence. I submit to you that due diligence is far more than that. The important part, and the most important part, is conducting a rigorous examination of the many factors that may affect future outcome. In other words, taking the wisdom that we have from our experience and looking at what is likely to happen on a playing field in the future, and then making decisions accordingly based on that, and figuring out, based on what may happen in the future in a worst case scenario, what valuation we need to invest at. So let's move into the core of due diligence, which is how you quantify risk. And it really boils down to 3 parts. First is, how do you discount for risk? That's analyzing what has a company really achieved compared to what the entrepreneur says it has. And then the second part is doing a comparison, looking at industry exit multiples for that given sector market, and saying, well, if this company had a liquidity event right now, what would the return be? And then gets to the part I just mentioned, which is the third part, which is looking towards the future and saying, well, if this does succeed, but it takes longer than planned and anticipated, what's the dilution going to be? And basing your return on that. Okay, what did he just say? Boil it down. Look at the past, the present, comparables, and the future. See if they've really gotten done what they said, and then look at worst case scenarios. Then you assess, what is it really worth? If you can invest in private equity rather than the market, you need to look at the risk after dilution in a worst case scenario. Okay, so that's quantitative risk. Let's get to qualitative risk and how we assess for qualitative risk. Let me tell you a story that is, for better or worse, a true story of the things that are hard to anticipate in due diligence. The company a lot of members invested in years ago was founded by somebody who is well known enough in his industry that basically everybody in this country and many people around the world are familiar with the product. He was launching a new company in his industry where he had made his money and built that company. However, he was launching it, co-founding it with a young entrepreneur who at some point when the company was raising its Series B financing decided that she knew better than he did, launched a proxy fight to try and remove him and take over. You could imagine that that stalled the fundraising. And his solution was to bring in basically a white knight, to bring in a private equity firm specializing in that industry that put in its own CEO. And of course, there wasn't room for 2 cooks in the same kitchen, and that person drove the person we invested in out, and the rest, as they say, is history. So this happens. So part of due diligence is assessing personalities, is doing background checks on people, is looking and seeing what is it about their personality, how are they likely to behave when human nature comes in the middle of what are our commitments. And a key part of that, the second part of qualitative analysis, is looking at people and seeing what their thoughts are on raising capital. It's what Paul Graham, the founder of Y Combinator, called the fatal pitch. We sit here looking at companies and presentations, and we routinely hear about their follow-on capital and how much capital they're going to raise. And so the question becomes, well, what happens if they do not raise capital? The fatal pinch is, as companies progress, if they're not making the progress that they anticipate, they become less compelling for follow-on financing. So the question becomes, look at the presenters and really push on, well, what happens if the next round of financing does not follow? What's plan B and what's plan C? Okay, so this brings us into topic 2, which is how to improve the process and why speed is important and how we can move the process along faster. So the due diligence committee looked back a few years ago at the pattern, and we couldn't establish a causation, but there's definitely been a strong correlation between the level of the due diligence process and how much members got behind the process. Obviously, Keiretsu, the numbers speak for themselves, has invested a lot in a lot of companies, and there are plenty of companies that received not insignificant capital from a couple of investors, even when there was no organized due diligence process. Yet the ones we really got behind involved cohesive, strong due diligence processes with multiple people involved. Now, where have we not met our maximum effectiveness, what the handbook was designed to have us do? Here's where we've slipped from the vision and what we can improve upon. We've associated length of process with thoroughness. We've had sort of this chicken and the egg where what we've done is we've waited for somebody to step up. And of course, everybody in the membership is busy and has their own lives. They've got their own companies. They're retired. They want to be doing other things. And we've sort of fallen into waiting for the due diligence leader to step up, and then the rest of us tune in, and I'm guilty of this too, tune in when the report is ready. Next thing that we've learned is we've tended to underuse technology, which can assist in really documenting thought processes, and too often the due diligence reports have become repackaging of information rather than this level of analysis. So bottom line is, what I want to start to encourage us to think about is dividing and conquering, is not overly relying on one member to lead a process and then report back. Now, if we can start implementing some of the things in the handbook better than we have and moving the process along faster, then what's that going to buy us? Why is completing a due diligence process faster important? Reason 1 is control, reason 2 is leveraged, and reason 3 is building trust. So the first investors to complete due diligence, even if they do not put in a majority of a given financing, generally end up negotiating the terms, even if they're a plurality of the round instead of a majority. Second thing is leverage, is if we reach a go decision sooner rather than later, during the time the round is closing, we're now talking with and working with the principals on how they're using money that's already in the bank, which of course leverages the money that we put in more. And the third, which is a little amorphous but critical, is we're building trust. When we're interacting with investors, they are in a time crunch. They're working against a burn rate. They're trying to, do everything a leader needs to do, which is raise money, build a company, build customers, build team. And at the end of the day, the faster they can get their capital raise done and get back to building company, the better for them. So if we show them that we move faster than other investors, we are building a deeper relationship. We're helping them out. So let's get into the meat of the due diligence handbook, also known as the due diligence process handbook. So that's kind of important. It's come to be known casually as this 400-page resource, which some people refer to as good bedtime reading. Thank you for the compliment. But it was designed and intended to, and if you look at it structurally, it is a 35-page process document supported by information and resources. It is not the due diligence handbook. It is the due diligence process handbook. And when we designed it, we were looking at it from a couple of perspectives. The first is, can a Burger King franchise owner lead the same level of due diligence as a tech mogul can on a tech company? And I say that lightly but seriously. We actually had a member early on in Keiretsu's youth that had a series of Burger King franchises. So I'm joking, but I am serious. And then the second objective was to have this process produce this type of robust assessment that I referred to earlier. And the third, and really the most important, is to move through this process in a way with a timing and a flow that results in one negotiation on behalf of multiple members. So it's a 6-step process designed to take, a couple weeks in each stage: organization, the gathering of members, the key questions and verifications, the necessary but I suggest not sufficient part of the due diligence process, then the deep dive into the company with the questions and the on-site visit where possible, and then into the reports, the producing of the reports and the commitments, and ultimately the deal closure, and then on to the syndication phase if the company gets that far. And one of the things I'm going to go into in a few moments is this emphasis on stage 5 and a deal closure process. Just as entrepreneurs forget that presentation is actually part of due diligence because you're preparing in advance, because you're showing investors what type of leader you are in terms of raising capital. Well, deal closure from an investor's perspective is not what comes after due diligence. It is a part of due diligence. As folks are making decisions about investing, they are still sizing up the entrepreneurs. So that's the 6-step process with an emphasis on the deal closure part of the process. So let me talk to younger chapters for a moment. Not every region has 300 members and an interest list of 25 people in many companies with 6 people ready to volunteer their time leading due diligence processes. So for younger chapters that have, let's say, 30 members and 5 people on an interest list and only one that's really going to do the due diligence process on behalf of the others, this is where to go to in the handbook. First, look at the Kickstarter document, which was created and devised by our Canadian region, and get the entrepreneur to answer those questions, preferably before presentation, but certainly if possible before any contact with investors after presentation. And then as you get into the process, get the verification level due diligence done. And there are appendices on the documents to review, the appendices on the sequence to review them. That's where you look first to get the verification level due diligence done. And so if you're not able to have 6 different people look into 6 different components and write subsections of a report, fine. Have the person that's conducting the due diligence on behalf of the rest of the membership just go to the quick summary report within a report appendix. And that appendix is there and designed to list the key questions of inquiry and just create a report based on that. And then I think the most important thing about due diligence, really the most important thing for younger chapters, is the following. Before getting into negotiating due diligence, reach out to somebody in the larger chapters. Ask them what their members are likely to invest based upon. And so when you're negotiating the terms, evaluation, what's acceptable to members in your chapter, make sure that you include what's acceptable to members in other chapters. So those are the appendices most applicable to younger chapters. Now let me talk about the appendices in general. So again, not the due diligence handbook, the due diligence process handbook, and what happens to support that 35-page process. So there are a lot of appendices, but here's how I'd like new members to think of the appendices. They're in several groupings. The keeping the flow grouping is a due diligence process values, and then the preventing bottlenecks, which is really arguably the most, I don't want to say the most important appendices are probably the valuation appendices, but closely following that is Appendix B, the guidance to be presented, and the Kickstarter document. It's about preparing the entrepreneur to be effective with investors so that there are as few bottlenecks as possible. The next one is Appendix C on the request sequence. When I put that in there, when I wrote that appendix, I was looking at all the different documents, and basically the premise is this. As we proceed, we're going to see whether there's going to be an investment or not. Don't make the entrepreneur and don't make the due diligence team review every last document. Take it as a sequence, and as you get through one set of check boxes and say everything's fine, then you move into the next and the next and the next. And make a mental note of that as we get into polling in a few minutes. Now, let me put in a caveat about that. A truly, truly prepared entrepreneur that knows they're going to be raising a lot of capital will have all this stuff prepared in a neatly organized deal room and binder ready to go anyway. But if they don't, take it one step and one set of information at a time. And then the appendices with the report outline and with the quick summary report are there to provide not just a continuity, but a common framework where every report comes out looking the same, and it isn't a compilation of information, it's a level of analysis. So ideally, look at those appendices and write the reports based on those. And then the next set of appendices, obviously the disclaimer as a due diligence process leader is putting together a document that a lot of people are going to see over time, and the process for maintaining a board seat are basically about how do we prepare for and deal with syndication. And then finally, the valuation appendices, including a recommended reading appendix, which I will mention towards the end. Okay, so let me get into 5 components where if you're using the handbook to its maximum potential, we can produce the same quality product but do so much faster. The first is using our technology platform. Proseeder is there. It's been selected to provide everything from the initial pipeline analysis to deal rooms to communication tools. And the emphasis should be on that last part. It's a communication platform. If we are actually not conducting our communications as a due diligence committee reviewing a company by email, but we're putting every question, every concern, every response in the discussion boards in that, then what we're doing is creating a level of analysis where the chapters that syndicate can move through the process faster, which in turn means that there'll be more capital at the table, which in turn means that there'll be more negotiating leverage because there are more people investing in rapid succession. And when the company needs follow-on capital and goes to raise later stage capitals, the entire thought process as well as the due diligence report is sitting there for others to review. So if we put it all in one place, everything present time and future time will move faster. Number 2, I've already alluded to in the appendices, which is the advanced preparation. Prepare the entrepreneur beforehand to reduce the number of bottlenecks. Number 3 is divide and conquer. If you look back at these key areas I mentioned a few minutes ago where we've said, geez, we can do better, they all really come down to this chicken and the egg of relying too much on one person. So ideally, when there are 5 people on a list of, let's say, 25 or 3 on a list of 15 that have expressed a willingness to do due diligence, the due diligence leader, emphasis the volunteer, should call people and just ask everybody in the area that they're most interested in or equipped to provide knowledge on to write subsections of the report. And then when it comes back to The report itself, the due diligence leader is there to compile the report, not do everything. So divide and conquer. And this is the only area which is the exception to put everything on Procedure, which is to get every member on the interest list to submit questions to the due diligence leader by email. That way, people that don't log on to Procedure are not overlooked. Which brings us to number 4, which is what really is the role of the due diligence leader according to the process handbook. And what about getting the due diligence leader to get a second person to be nearly as actively involved as the due diligence leader? The due diligence leader should really come in towards the beginning and at the negotiation and the report stages, and ideally find somebody to help out in the middle. The due diligence leader makes a connection with the company. They establish the relationship. They set the stage of what to expect, and then they organize a compilation of the drafts. Somebody else needs to come in, ideally, as a best practice, and oversee the verification process, handle the logistics of the site visit, basically handle stages 2 and 3 so that the due diligence leader will not be burnt out or have spent too much time away from their other commitments, obligations, and a fully retired recreation for the critical negotiation part and compilation of the report. So it's really a two-person team if we're functioning according to our full effectiveness in these processes. And then finally, I mentioned I was going to get to this before, polling. And note I put an underline under S, it's plural. Polling the members in that 35-page process component. I'm pretty sure there are 3 times where the process calls for polling of the members. And the reason's simple. Due diligence is finding out new information. It's deepening an analysis. So stuff is going to come up. New information is going to come up. Spare the entrepreneur the time and let them move on, and spare the members in the due diligence process the time if something has surfaced that leads to the deal basically being, for lack of a better expression, dead in the water. So that brings us to a quick recap. And I'm actually going to read it because it's kind of cute the way I wrote this down. Okay, so now we're using the handbook to its full potential. We're reliably getting from presentation to completed high-quality reports and commitments in 6 weeks, and people are ready to make decisions, and we have rested and jazzed due diligence leaders, and we're all at the table quickly as a cohesive unit talking turkey. Cool. Now what? How do we use that to our benefit? So that brings us into these new best practices that I would like to begin introducing here as a next evolution of the due diligence process within the Keiretsu ecosystem. So we're going to talk about setting expectations for communication and team and alignment with investors, and using that as a process for managing risk and managing proactively for risk. So I said before, and I'll repeat now, due diligence doesn't come up to the point of negotiation. Due diligence includes the negotiation process and the deal closure process. As it's now written, Appendix 6, which was added into the most recent version of the handbook that prepares for syndication, says, okay, now after the investment, let's look at setting expectations for communication. Let's let the entrepreneur know that to really benefit from the fact that they now have multiple investors, not just one venture firm, investing in a financing from Keiretsu members and the membership as a whole, you need to be communicating with us. You need to let us know what's going on so we can help. You need to give us financial reports quarterly and emails monthly. I submit that we need to move that from stage 6 to stage 5. to set that expectation before the investment happens while we have the most leverage, and to begin a process of creating alignment on how to use capital to de-risk companies. So these need to be done ideally before the negotiation happens and before the finalizing of the deal terms. So what am I getting at here? Why is this important? I'm going to submit to you that one of the benefits of being a member of the Keiretsu Forum or any organized angel group is that we have a wisdom quotient. We say experience counts. We want to invest in folks that know an industry, have built companies in that industry. But look back at what I was talking about qualitative as well as quantitative due diligence and how human beings are likely to behave on a playing field. Well, human beings are human beings. They have blind spots, they have personalities, they have life lessons that come into the simple commitments of I'm going to build this company. A larger number of investors have a collective wisdom, the wisdom quotient, to catch those blind spots, to be an influence, to provide resources. So there are a few ways to bring the wisdom of investors. And by the way, we're a platform of 2,500 plus investors now. So if the notion of two heads are better than one is true, and I believe it is, then 40 heads are even better than two. So we can invest in tranches, which to handle risk, which I don't think is really practical. Because if a company is going to need a full financing, it's going to need a full financing. We can turn passive investors into active investors by proxy, which, by the way, is what venture firms do, and now what we're beginning to do with Keiretsu Squared, to put in our own trusted specialists and executives. But if we're not going to do either of those, then what we can do is basically build a partnership with the company, is to create, as part of the deal closure, commitments for communication and alignment on how these companies are going to be built. And that's how we bring the wisdom quotient into reality to de-risk companies. So in addition to the wisdom quotient, there's what I call transmission interference. In an ideal world, the multiple, several dozen investors that might invest in each company from within the Keiretsu Forum network are in regular communication with monthly emails from an executive, with quarterly financial reports, letting us know what resources they need, who they'd like to be introduced to, and then we're able to communicate back with feedback. And then there's reality. Does this picture look familiar? Finding out after the fact, before it's when it's too late to help out. All right, so humor aside, there are two solutions that I'm getting at here that we can use to build alignment. So that brings us to solutions to bring alignment into the process between investors and entrepreneurs. I want to reference something the Ohio Tech Angels group does, and then bring in a new best practice that I want to see us start to use, or would recommend that we start to use. The Ohio Tech Angels has an investment philosophy, and remember, they're 100 plus members, we're 2,500 plus members. What they do is they look at what the likely liquidity event, the likely acquirer is for a company, and before they invest in that company, they get agreement from the investors that they're going to build the company towards that acquisition. That gets the entrepreneur working in a specific direction, and then that gets the investors ready to begin seeding and introducing contacts of potential acquirers. And I think that's a great idea and limits the potential outcomes, in my opinion, for that company. If you're only looking in one direction, you're removing potential pivots, you're removing potential customer bases. So there is a way to build a company to a liquidity event actively faster without having that limitation. And that's the alignment process. And it's getting everybody moving forward in the same direction, anticipating risks. And here's the thing. So the reason I say this is part of the due diligence process, not just something that comes after the due diligence process, is because when you're creating alignment with the investors and the entrepreneurs at how the company should be de-risked and built, you're going to quickly see if the entrepreneur is willing to listen to our wisdom quotient, is willing to work with us. If you get a sense that they're just going to do it their way, that they're not going to take our feedback, that is a red flag. We could look towards introducing actual written commitments before investing. They won't be binding, but it's a way, again, to create an expectation of working together. And this also begins to allow us, like the Ohio Tech Angels do, to begin anticipating needs beforehand. So let's actually look at the alignment process document that we're now introducing. I mentioned earlier to please go to the Keiretsu Squared section of the Keiretsu Forum website. In addition to the velocity program overview is this team alignment document. For Keiretsu Squared, it's designed to unearth leveraged actions and get the team working together cohesively. It's a central document that our specialists use in the velocity program to focus in on all the critical needs of a company to be solved. But it's also been designed for the benefit of members in the Keiretsu Forum side of the ecosystem. So that's how we use the team alignment process in the Keiretsu Squared side of the Keiretsu ecosystem. It's also there for Keiretsu Forum members as part of the due diligence process. So if the investors, lead investors, and members get together and actually complete this document and this process for companies, and then get several, not just one, several of the members of the executive team to complete it and sit down before investing, a couple things are going to happen. And the most telling one is going to be, you're going to see how coachable these entrepreneurs are. Both the ones that maybe have only built one or two companies and the ones that have built 4 or 5 companies that may actually be less open to feedback. So it becomes a due diligence process document for qualitative risk. And the second part of using this document within Keiretsu Forum as a tool within due diligence is it will enable us to think about what conditions we might put in place. So think hypothetically about a company where you're leading as a due diligence leader the negotiation, and you know what people are interested in, you know what people are on the fence, and you know why. So now you know what the potential investors are looking at as the most leveraged next actions to build customer demand or to remove risks. And you can basically send that company out and say, okay, based on what we looked through together in that document, go out and do this in the next 6 to 8 weeks, and that will lead to the investment. So it's a tool to build alignment after investment, and it's a tool to complete the process, and it's a tool to assess how people will interact with investors over time. So take a look at the document. Let me just highlight a couple of key things. I've actually conducted this process for myself and used it a bit, and it is designed to drill down when you think you're there, to go another layer, another layer, another layer. So skim through the slides and look at some of these different components, and then go look at the document itself. Okay, I mentioned the valuation was a key component, and that there was going to be a recommended reading. In addition to the 3 appendices, I think it is, in the handbook on valuation, please go take a look at the recommended reading appendix. There's a set of material that was created, 10 articles grouped together by the Kaufman Foundation that were written by some of the most premier angel investors in the country, called Valuing Pre-Revenue Companies. Take a look at that. It's equally applicable to valuing pre-cash flow positive companies, and that material has the core, in that material is the core of how to make go and no-go decisions based on what the actual return will be. So that brings us to key takeaways in sum. Number one, a due diligence process handbook is just that. It is a condensed process. It's not a 400-page document for bedtime reading. It's a process document. It's not just an information resource. And embedded throughout that process document are methods of making the process move faster. Making the process move faster builds trust, builds influence, helps us strengthen the foundation for a long-term relationship, and more importantly, enables us to complete that process so we have a cohesive negotiation with multiple people at the table at the same time. Let's try to divide and conquer. Let's try and get a first lieutenant in every due diligence process working together and delegate out parts of the due diligence report, 4 hours times 5 people. That's all we're asking for, 4 hours to handle a specific subsegment of the report. Then structure into deals the requirement for ongoing communication and updates. Use the wisdom quotient of dozens of experienced and well-connected investors. And finally, just use that team alignment exercise. Whether anybody interacts with Keiretsu Squared or not, it's there for Keiretsu Forum members to help them work together to de-risk companies. And here's how to contact me. And with that said, let's move into questions. Any questions, Kim?
Excellent. Well, Michael, thank you so much for a very informative discussion about due diligence. I think if we were going to spend some time in our day really investing in our lives, concentrating and understanding how we can make better decisions by a more thorough due diligence process is certainly one of them. So thank you very much for that. Here we go. We've got several questions. The first is, are you emphasizing that the process is about building up to negotiation, but we are often dealing with companies that have already received significant capital in a financing negotiated by investors outside of Keiretsu? What do we do if the valuation is already set?
All right, well, a couple thoughts on that. I would say that we take that in 2 stages. So there's always room to negotiate something extra, be it warrants or some special thing within a financing that has set terms. So the first chapter that's negotiating the deal for Keiretsu members, I would say to put something out there, whatever's appropriate, meaning extra warrants or something that gives an incentive for a certain amount of capital, and then make that conditional on, let's say, 2 or 3 or 4 other chapters reaching a certain collective amount. So let's say there's $250,000 soft circled out of $4 or $5 million, I don't know, we'll call that going into Series C financing. Well, let's say if we collectively, if you move on to other chapters, we collectively put in $2 million, then whatever these terms we negotiate will be put in. Obviously, that's subject to the other investors agreeing, but it's a good place to start. So conditional on a certain amount of money being raised.
Excellent. Oh, here's a follow-up for that. What do we do if someone in the membership goes forward and invests without waiting for a group negotiation and investment?
Okay, well then it's probably too late to undo the damage. So all humor aside, is why everybody needs to be on top of it, and a due diligence leader should ideally be getting everybody on the list in communication. Reach out to folks in phone calls and just ask people to be patient to try and proactively prevent that from happening. That said, that allows us a chance to maybe touch on convertible notes, which isn't really the subject here, but it's worth talking about. You will have situations in which certain investors are moving ahead of others in sort of a preliminary convertible note, deal structured as convertible notes rather than priced equity. Again, bear with me. It's a little outside the scope, but it's something important. The The convertible notes are good for companies, they're good for entrepreneurs because it allows them to defer out into the future, setting a price and picking a valuation while they're reducing risk. Obviously, the opposite of that is for investors. You're investing in something and then a company is being de-risked and then it's being priced. So if you are dealing with members that are putting in money based on a convertible note before the entire financing, which would involve Keiretsu members, is wrapped up, then make sure that there's a cap on evaluation in a convertible note. In other words, when it converts, and make sure that there's some level of incentive where that early investment has some extra benefit for the extra risk. So two parts to address in that question, or two components that question created as food for thought. What else?
Well, I would also say, make sure you stay connected with the group so you don't get left behind and you don't get out in front of the curve, get out in front of the group. Here we go. How do we find accurate industry exit multiples?
Well, you could do it the hard way, which is to research and find them. The sources are out there, or you could do it with the benefit of the membership. Yeah, I think there's one of the benefits of the membership is everybody has different levels of expertise and different backgrounds, and they come from different industries and they have different knowledge bases. And even if somebody is not necessarily interested in a specific investment opportunity, they're willing to help because they know that the situation will be reversed at some point and they might be interested in investing and want to turn to someone else for expertise. So just figure out if it's a company in clean technology or software as a service, figure out who knows those industries, and they're likely to be able to point you towards where to find the research or to cite companies off the top of their head and who's acquired whom. Ask for help, in other words.
There you go. All right, not sure I understand the second part of this question, but here it goes. You advise that we put all communications on Procedure, yet one of the core process values is to express contrarian views with due process. How far do you go in expressing concerns before someone has done the research?
I think what they're getting at is, to what extent do we use Procedure as a tool and a platform to post documents and then post reports, and to what extent do we use it to discuss, to talk about concerns, to say we should ask the company this, to say we found out that. And as I mentioned, I think before, or at least alluded to, we want to be doing that because if somebody comes in from another chapter to co-invest, if somebody comes in another financing and looks at the due diligence that was done earlier in a prior financing, if not only the conclusions, but the questions and the thought processes are sitting there, it allows people to say, okay, that's already been asked and answered. So let me say that put everything that is a concern there, but don't use blanket statements. Be cautious about, what is your assessment? Say, I've heard of a company in this industry, or I'm concerned about whether this company might really have used a consulting group where the technology didn't pass on. Voice everything, but use specifics, use facts, and don't use blanket statements.
It's always helpful to get the details.
Yeah.
Well, we're talking a little bit about Procedures, and that is a technology tool. And the next question is, how else can we use technology to improve due diligence? Do you have any other thoughts for us?
Well, I think that Pacific Northwest and some other chapters are starting to use tools that organize and create a workflow, project management tools to keep things moving faster and more cohesively. So that is one suggestion, but that's ultimately up to each chapter. So nothing else comes to mind. Procedure is a pretty robust platform and really gives investors, I think, everything they need. So nothing else comes to mind other than project management tools.
Excellent. And this is the last question. Of course, if we didn't have a chance to get your question today, please feel free to reach out to Michael at any time. I'm sure he'd be happy to talk to you about your concerns, questions, and perhaps entertain some ideas that you may have. So Michael, the last question is, and I hate to kind of leave it on a downer note, but here it is. Who steps up and breaks the bad news if the early polls say that there has been a significant loss of interest after early examination?
Well, you could pass the buck and ask the staff to do it, but ideally, there is a due diligence leader in the process, and the due diligence leader ultimately has to do that. That said, let's look at how that's supposed to work. There's some levels in which I think in stage 6 some feedback is given for that in the handbook. Really make sure in those conversations that value is added in some way. Talk about why the conclusions were reached. Talk about what they could do better. If there are resources we could add those resources. If something came up that is a real deal killer or a real, makes a deal a non-starter, then that's one situation, but there may be situations, or a fatal flaw is a term to use, but they're more likely or equally likely, you're dealing in that conversation with situations where certain things can be done to allow them to come back around again, and tell them what they are. It's a dating game. When you're dealing with a membership that has 2,500 members and you're dealing with the opportunity to syndicate with other angel groups, you're dealing with the opportunity to partner with, breakaway funding and the investors they might source, and the approach that you use here, Kim. There's people are going to be having a chance to come back around in the future, and people are going to be having a chance to get interest elsewhere. So leave folks with value in that conversation. And due diligence leader is ideally the person who has that conversation, because they have heard from the most people and they have gotten the most feedback. And so they're the ones that can deliver the value and say what really needs to be done for them to be more effective.
Well, that's an excellent kind of a wrap-up thought. That is the end of our questions for the session. I thought maybe, Michael, you might want to give us some last-minute thoughts before we wrap up the presentation today.
I think most things have been covered. Again, we can get due diligence processes done much faster than we historically have, and I'd like people to sort of focus on that. It does not have to be that hard and that time-consuming, and I really want to encourage people to use the team alignment exercise to look at actually building conditions into opportunities, and of course to pay attention to the whole is greater than the sum of the parts of the evolving Keiretsu Forum ecosystem. If you've got any questions about Keiretsu Squared, email me. We're out here now with Keiretsu Squared as a new evolution of the model to protect investors, to protect our members, and to help our companies succeed more. This isn't anything new. This is what venture funds have been doing to bring more to the table and to protect their limited partners, and that's what we're starting to do. So thanks for taking a look at all we do, and welcome new members as Keiretsu continues to grow, and thank you for your time and your interest in this fun but important subject. Thank you all for joining and participating.